I'm Ben Summers, and welcome to the Shadow Banker Secrets podcast, based upon the book I wrote by the same name. Today we're going to go beyond the book and discuss retail financial advisory. We're a boutique investment bank and private structured products desk that's simply not retail facing. We've got over 124,000 high net worth individuals in our ecosystem that we're not positioned to serve, ranging from accredited investors, of course, through qualified purchasers. This led us to initiating a pilot program with fee-based RIAs with discretionary authority who have the capacity and the willingness to pursue a merit-based approach in their growth objectives. I'm joined by my good friend and colleague, Stephen Piscano, who out of his own frustration with equities markets and retail financial advisory, became a professional real estate investor over 20 years ago. And since that time, has accumulated over 2 million investors in his ecosystem that share his perspective. Stephen, it's good to see you. Thanks for joining us again. It's been a little while since the last time we had one of these conversations. Quite a bit has changed, and I thought now would be as good a time as any to really highlight your alternative perspective and how that relates to the financial advisor world, what they can learn from your experience and the efforts that you made, again, to generate a following of over 2 million investors through your professional real estate investment career, and how that effort is not specific to real estate. Real estate, and correct me if I'm wrong, was the conduit because you just needed something, because you knew, and all the people who are following you knew, that the equities markets and retail financial advisory just wasn't the ticket. You kind of sensed something is off about it. And tell me a little bit about that. So how did you go from, again, looking for an alternative path to generating the tangible results of 2 million retail investor followers and a successful 20-year career in the retail space and the real estate space?
You aged me a bit there, my friend. But no, first of all, Ben, thank you very much for having me back with you on the podcast. And, I really was thankful to come and chat with you right now, because I think what's happening right now in our history is a critical time. And it's funny because the last time I was with you, it was back in March this year, and it was really maybe 2 to 4 weeks before stuff kind of hit the fan and the financial markets started to collapse. And a lot of things that we talked about back then, I think, are now starting to actually happen. And so it's one thing to predict something. It's another thing to predict it and be able to capitalize on it and actually have a negative turn into a positive. And, it reminds me a lot of 2008. Like you said, the last crash that we saw, which was really a key point in my life for building the following that you mentioned that I have, is because out of the couple million and 2.5 million members of my network that I've been able to cultivate over the last 12, 13 years here, one thing that we all share is two things really. We have a desire to think outside of the box, be creative, work against the grain, find investment avenues that are not talked about in the New York Post, that are not talked about on the daily news, and be able to maximize our net worth. But we also, to be honest with you, we have a distrust for the traditional financial systems. We have a concern for what's taking place in the everyday marketplace, because what we've seen going back several decades now is that when things hit the fan like they did in 2008, like they are doing right now in 2022, we're the ones that get penalized. So we're looking for a different way to do things. We're looking for a way to, to get some of those benefits that have previously been reserved for, the ultra wealthy elites of the world. And I've been blessed to have some success in my life. A lot of members of my network have. We've got a lot of accredited investors in the network that have been very successful, as you mentioned. But still, these types of opportunities are not readily available to us as everyday investors in the marketplace. And so that's what I love about what you've built, the infrastructure that you have, is that you make some of these strategies available to normal people like us. And I think right now, honestly, it's critical with what's happening in the marketplace. People need to know about what you're doing. They need to know about how they can participate. And we need to be prepared to adapt and have the flexibility to make sure that not only is our retirement savings protected if we have another catastrophic crash like we did in 2008, but that we can actually benefit, come out on the other side stronger than we were before.
Yeah, I appreciate that. I'm spending a lot of time, especially the last few months, talking to RIAs. They're in their 50s. They're trying to scale AUM in the 11th hour of their career to get that nest egg that they can either sell their firm from or have a residual income effectively through their advisory practice that allows them at least to have a sort of a career that's not labor intensive to keep them in sort of a strong financial position for the next several decades. And they're all really challenged with growth, right? And the irony is that they are all buttoned up. They are adherent to a very strict regiment of compliance. They are selling financial products that are sanctioned by every regulatory body, right? They look around and they see real estate being run in a relative haphazard way, again, as compared to the compliance and regulatory standards that they adhere to, but yet they struggle to get new clients into their practice. Now, obviously, there's a lot of cannibalization amongst themselves, right? So smaller advisors are competing against bigger advisors and whatnot. But I think the point here is that there are trillions of dollars outside of the retail advisory space right now that are genuinely looking for strong investment advice, strong investment products, exactly the types of things and that you and your following are pursuing, right? And I guess the question that they would probably have is, what can they possibly do to move someone from your perspective and your followers' perspective who are, maybe not ardent real estate investors, but certainly value real estate as an asset class greater than others? What could they do, if anything, to sort of salvage that segment of the market for their own practices?
No, that's well said, Ben. You hit it on the head, because I think one thing that's been apparent to me in conversations, because, so my group, the Real Estate Networking Group, obviously I don't talk with all 2 million people, but I do have conversations on a regular basis with, hundreds of members of the network. And that's a common consensus is, yeah, there's concern about what's going on in the marketplace, but it's not a fear of investing. Actually, there's a great desire to invest right now, but it's in wanting that guidance on the smartest way to do it and the safest way to do it. And while real estate for us, and for myself personally, has traditionally been the asset class that made the most sense, I think there's a general consensus that we're not married to that. I know I'm not. And I know, like GP stakes, for example, when I really started working with you on a closer level, I've known you, on a personal level for 6-7 years, but the last couple of years, I've learned things that just blew my mind. And the people in my network that I've exposed some of those strategies to were awakened to a different way of doing things as well. So I think what I found that's been honestly kind of a surprise to me as a real estate investor. I bought my first property when I was 17 years old. I've been doing this for a long time. And I think myself and people in the network, it doesn't matter if it's gold, it doesn't matter if it's stocks, it doesn't matter if it's crypto. I know you hate crypto, or real estate. We just want the fundamentals that are going to capitalize on the opportunities that present themselves and be able to, at the end of the day, create that high return. And you can probably elaborate on that better than I can, but the risk analytics, when I really walk people in my network through what you've built there with being able to identify how any investment, regardless of what asset class it's in, can be successful in chaotic times, that's what's added an extra level of comfort to us.
Yeah, and that dovetails precisely, as you pointed out, to the perspective that we evangelize about when we're talking to our peers and colleagues in the financial services space that are generally married to equities and packaged products, publicly traded assets.
Well, and so Ben, one of the things that's really got me excited about everything that you're doing and everything that you built with Adagio is it's not about the story. It's not about how I feel about a property or even how I feel about an asset class. It's about fundamental numbers that are factual. And it's something that we can track. It's something that we can have a foundation of that gives comfort when I look back, not only at the history of the last 15 years where we've had the crash of 2008, the recovery that was a record-setting recovery from 2012 really to now. And then now we're going in potentially to another crash, another dip. Well, it already is a dip, but definitively a time of chaos. And in a time of chaos, to me as an investor, what I want is a metric that I can look at that gives me a sense of stability so I can choose the best investment strategy and the best investment class that's going to give me the opportunity to grow my portfolio. So would you mind, I know I'm technically the guest, but I'm just curious, just for myself personally, can you walk me through the fundamentals of how you measure risk, what that looks like, and how you developed it? Because I know when you, and I've been bugging you about this in calls, for 6 to 8 months, asking you questions repetitively about this same topic, but walk everybody in my network through how you measure risk and how that helps us evaluate a prosperous investment.
Well, you brought up a very important point, which is when you look at 2008, when the markets were crashing, all of the traditional portfolios, the retail portfolios, got hammered. They were lost an average of 50% of their value. There were not many people who did well, but the few who did were alternative asset managers, right? They weren't a typical retail advisor. And this is really important to people, right? Like the retirees, baby boomers who have a nest egg that they have to live the next 30 years off of, can't afford a mulligan every decade when a bad event occurs. And so I get the criticism of the financial services space in that, well, when you look at alternative asset classes, specifically real estate, there are a lot of players in that space who aren't as rigorous as they probably should be. They don't address all of the compliance and regulatory and operational standards that a responsible allocator would want to see. But at the same time, the arbitrage opportunities in private markets are the only place you can go to escape the invisible hand of the market, these crashes. The fact that FINRA even says that market risk is not diversifiable. So the opportunity lies precisely where the institutional space lives, where you look at an investment based upon its performance per quantitative standards. They measure its risk-adjusted performance. And when you look at an asset or a portfolio from a quantitative perspective, accurately measuring the risk-adjusted performance, taking into account all 4 statistical moments of risk, looking across a minimum of 1 complete market cycle, the conclusion always leads to the alternative space, alternative assets. But what the institutional space do is now they also employ the rigor, the operational rigor, the compliance considerations, the regulatory adherence that take the best of both worlds. The benefits of financial services that retail advisors hang their hat on with the raw performance potential of alternative asset classes, private markets, bringing both of those worlds together, finance and private markets, into the best constructed portfolio possible. That's why when you look at an institutional portfolio, it's 60 to 70% alternatives, as opposed to the 60-40 model on the retail space. And again, these decisions aren't based upon an emotional attachment or an affinity for any story or asset class or otherwise. Accurately measured risk-adjusted performance, the only thing that matters in investing, not including liquidity, right? When you look at that, the numbers tell you where to go. And there is nothing that prevents anyone from applying institutional standards to an alternative investment strategy or an alternative investment class. a lot of people who really don't understand risk analytics will say, oh, that's just for equities. It's not true. The benefit of risk-adjusted performance measures is that it gives you the opportunity to compare anything. You can compare a real estate portfolio to a single stock. You can compare a wine collection to the S&P. You can compare anything to anything, the apples to apples term, right? It's just a statistical analysis of historical total returns where the period corresponds with the liquidity of the asset or portfolio being analyzed. And once you make the realization that the only thing that matters is accurately measured risk, return, and liquidity, when you get rid of this religious adherence to an asset class, oh, I'm the Series 65 guy and I've got to sell, publicly traded stocks and equities and fixed income, or I'm the real estate guy and I can only buy real estate. Once you move into just saying, hey, my real goal is to generate the highest returns I can with the least amount of risk, and you understand that can be measured with a very precise ruler, which are these quantitative measures, then you follow the numbers, and they lead you where the institutional space already lives.
Yeah, well, I mean, just what you made me think of when you're talking about that, it reminds me, I was talking with my wife about it because, everybody in my network knows I bought and sold a few hundred homes in Detroit during the last crash, and most of those homes I bought for somewhere between $500 and $1,000, right? And then we bought a lot of properties in Las Vegas for $10,000, $15,000, $20,000, all this stuff. And there was no pride of ownership in any of those properties. And I would talk to, my wife would say, we'd drive by a property in Las Vegas that I owned, and she'd say, wow, that's a piece of garbage. Why did you buy that? And I'd say, well, because it paid for the, the necklace that you're wearing right now. And it was ugly houses get great returns, but you can even extrapolate that more and take it to where it doesn't matter what asset class you're in. It doesn't matter what strategy you're doing. I would rather earn 32% investing in XYZ than earn 16% or 12% or 6% investing in real estate, even though I'm the real estate guy. I love real estate. It's a passion of mine. But if you tell me I can get 32% on my money doing something else, I'm going to give it to you 10 times out of 10 because the end result is all that matters. It doesn't matter how pretty it is. It doesn't matter what the backstory is. It doesn't matter, the pride of ownership. As an investor, our top priority should be how much money do we invest and how much return do we get on that investment? And that's what you've really been able to crystallize for everybody, both in the retail sector and in the institutional space, is, what that looks like from a mathematical formula.
Yep. And correct me if I'm speaking out of turn here, but I'd go so far as to say is, despite the veneer and the polish that retail advisors portray, intuitively you and your followers kind of know instinctually, and I think most investors know that there's something not quite right about it, right? You can just kind of sense that, well, what happened, in the last financial crisis? What happened in the crisis before that? And what you find is that all advisors tend to perform about the same. They're all selling the same portfolios, and their performance, when measured, is not good by any standard, right?
Well, you're right. I mean, and honestly, and that's one of my favorite sayings is a rising tide floats all boats. So the last 7-8 years when we've had a recovery, an extended recovery, everybody's getting 18%. So if somebody comes to me, this is just, legitimately my personal opinion. If a financial advisor comes to me and says, hey, I've earned 19% in 2021, I'm not impressed by that whatsoever, because I could have invested in the S&P 500 and earned 19%. And it feels like, and I'm not in that world. You are, I'm not. But as a retail investor that is an accredited investor, just being truthful with you, if someone comes to me and they show me returns that closely mirror the performance of the large stock market indexes, I'm immediately going to ignore that person. If someone comes to me with a different strategy, if someone comes to me with something that's outside of the box, honestly, and this is just Stephen Piscano talking, me personally, even if there was times when they performed lower than the major stock market indexes, I would be more intrigued by that because I know they were thinking for themselves and that they had something that was different. And I think my network feels the same way. I'm not going to speak for 2 million people, but I think we feel the same way. If you've taken the time to investigate a strategy that is different, that gives us an opportunity to go against the grain and potentially have more success than everybody else, because anybody can just throw their money in with the masses, and then you're going to rise and fall with everybody else. That's fine if that's what you want to do. But my network, what we have in common collectively is we want to at least seek that opportunity to do better, and get the same type of opportunities that are reserved for an upper class of people. And I think that what you provided, and again, kicking it back to you, I think what you provided does that to some extent.
Yeah. So what you described, it's beta, right? So the people, the more sophisticated people in finance, your CFAs, obviously lots of MBAs, when they begin to talk about quantitative measures, they tend to only speak in terms of second order considerations, alpha and beta. And that's exactly what you described as correlation. So to what extent does an investment correlate or track, right, the benchmark index? And that is a good starting point, but to sort of build on that, and that is enough to build intrigue. But I'd go so far as to say that's not enough. That is enough just to, again, build intrigue. But you have to look at all four statistical moments of risk. You got to look at the skewness, right? How much does your investment, how much do your potential losses, rather, compare to your potential gains? The example being an option. An option, by definition, when you buy an option, you put a little bit down, and it's potentially infinite upside. That's the third order. That's skewness. Kurtosis is tail risk. So when a bad event does happen, how bad are the repercussions, and how frequently do these things actually occur? So looking at correlation is just the second of four moments. But again, it is enough to initiate intrigue, because generally speaking, if an asset is going to do well in bad times when everything else is failing, it's not going to be perfectly correlated, right? And this goes, again, back to, I think, what leads to a general mistrust of retail financial advisory. It's this heuristic-based business model where FINRA, which is a self-regulating organization assembled by the biggest wirehouse and the biggest firms to make sure that everybody is singing by the same choir sheet, same hymn sheet, those heuristics are often counterintuitive. Those heuristics generally do the opposite that they are intended to do, right? So one of the first questions you're ever going to hear as an alternative asset manager from a financial services professional is, what's your AUM? How much money do you have under management? And the implication in that is you've got to have a minimum asset level for us to even consider investing in you. Well, the research clearly shows, precisely, that the lower the AUM, the better the performance and capacity for performance. When asset managers break that 50 million AUM threshold, invariably the performance begins to decline. So where would this come from? Whose interest would it benefit, right? If you're only allowed to, if you believe that you can only invest with asset managers that have $1 billion under management. Yeah. Is that really a merit-based heuristic? Or might there be another reason you were led to believe that that's the best way to make a decision? And that's the first question you've got to ask, too. What's your AUM, right? And that's just one of many, many examples. So when financial advisors believe they're managing risk, what they tend to be doing is parroting rules set in place by the leaders of the industry who are trying to protect their position. Those rules, those heuristics, the respected dogma that governs how retail money is allocated is designed to keep the money where it is and to stifle competition, which is exactly the opposite of what would need to be done if you're trying to pursue the best performing portfolio you can. So I get it, and I use the word dogma with intention. Use heuristics. I use AUM as one. Private versus public is another one. We always want to be in public assets because they're liquid and they're transparent. They're not transparent. I worked at publicly traded companies. The 10Ks and Qs are complete fucking fiction. Ask me how I know. I sat by the auditors who were fed information from our president, who completely fabricated information and strong-armed the intern auditor from KPMG, right, to make the books look the way we wanted the books to look. And I'm telling you what happened is, especially in the energy services business, accrued gains would show up for years until the realization or the realized returns were forced to hit the books, and there'd be a predictable loss every few years because it was all fiction. It was all fiction because it was all manipulated. So again, this belief that, we're in publicly traded companies, therefore it's safe and transparent. It's not. It's just a more sophisticated level and a thicker veneer covering the corruption.
You pretty much cleared it up for me there, I think. But this was just as a retail investor at a fairly high volume, my takeaway on that is and I'm just curious, honestly, just personally, if this is your opinion, but it sounds to me, and this has always been my belief, and I think a lot of people in my network's belief, if I'm investing in, a fund by Goldman Sachs with my IRA, if I'm investing in any institutional funds that's mainstream, those funds, it's always felt like those funds aren't picked by what's going to earn me, the individual, the best return. There's another motive there, and you are pretty much confirming that in your opinion, correct?
Well, generally speaking, you're not going to see sophisticated funds engineered by big wirehouses made available to retail investors or through an IRA or 401k. You've got these really shitty mutual funds that are just an unmanaged bucket of stocks and or bonds, right? And they're just going to follow the market, right?
Well, if you call your RIA, which I did when I was in my early 20s, and I'm like, hey, what stocks am I actually invested in? They don't even know most of the time, right? I mean, for mine, they didn't.
They don't. They generally don't. It depends who you're talking to, but that can be very opaque to your point, right? So where's the transparency there? But furthermore, when the market as a whole goes down, when we experience financial crises, all of those things go down. And you don't have to look that far in the past to see it. Like 2008 was a perfect example, right? So again, if an advisor is willing to step away from the religious adherence to the beliefs that are instilled in the culture of retail financial advisory, and to step outside and just think from a merit-based perspective for just a minute, then these things become obvious. Another one is like, we don't like private funds because they're illiquid. Well, if you're a retail advisor and your client has a liquidity horizon of less than 2 years, where should their money be? Their money should be in cash equivalents and money markets. They shouldn't even be in the capital markets. So stocks are off the table. So you're not even putting them in stocks unless they've got a horizon greater than 24 months. There are many, many, many funds with lockup periods of 24 months or less, especially 5 years and less. So when you're talking about capital market money, it's a minimum of a 2-year lockup, generally much, much, much longer. So the liquidity, how is that a relevant consideration? But you'll hear it, right? Private funds can't do them. They're liquid, right? We need liquidity. So there really is no rational justification for the way retail advisors construct portfolios for their clients. It's simply parroting what they've been told to do, or they're not even doing it. They're having a TAMP do it on their behalf or some other money manager. And the retail market, as I think, as you are attesting, recognizes that. And even if you can't articulate it, you can feel it, right?
And we can't yet. Well said, because that's what I was just going to say too. Is you hit it on the head. Like, honestly, there's some things you're saying I don't even understand what you're. I don't know the terminology, and I know that a lot of people don't. But what it is a general distrust, and it's just common sense. You know, you and I, Ben, we've kind of joked about that quite a bit, because you'll have a mathematical formula or whatever it may be, and I call it common sense. But to me, it's just common sense, to where if I'm always doing the exact same as everybody else, then why do I need you? You know, why don't I just go and do my own thing? Why don't I get a TD Ameritrade account and just go invest on my own? If we're all, you know, rising tide floats all boats, and we're all sinking at the same time, why do I need an RIA and or a financial advisor of any kind? And that's been the general principle, honestly, and that's what led me to real estate. And it wasn't until I started, you know, kind of working with you and looking at some of the things you do in other asset classes, I was like, oh, okay, there is an opportunity to where we can still maximize our potential, and we can get guidance from someone else. Because I'll be honest, I mean, even though I've been successful investing in real estate, you know, when I've played around with stocks, I've made some mistakes. Or when I've played around with precious metals, I've made some mistakes. There's always an expert in every given class. And I think we as investors on the retail side, we want guidance. We just want to know that that guidance isn't looking at a checklist and checking a box. We want to know that that guidance actually comes from a fundamental set of principles that make sense, that we can measure in layman's terms and quantify. And I think if people just did that very bare minimum, to where they just had that set of principles that was orchestrated and explained in a common sense way, I mean, myself, I know I would be interested in investing with that person. I think a lot of other people would as well.
Yeah, and you hit a good point there too, which is a lot of advisors, when I talk about quantitative risk analytics, will push back and say, that's too complicated. I hardly understand it. There's no way my retail clients can understand it. And the point is, they don't have to understand the mathematics. How many times have you gone
The end result. It's the end result that
matters. It's the end result. Yes. You don't have to be able to reverse engineer an iPhone to appreciate that an iPhone works, right? When you go to a cardiologist, you don't demand that he teach you open heart surgery before you have a triple bypass done. You don't demand your lawyer teach you how to litigate a case before you hire him to represent you. If you have any value and represent any value as a financial professional, no one expects you to teach them how to do your job. No client expects a self-respecting professional to teach them how to do their job, right? And these numbers can be communicated in a very simple way. Again, look at a ruler. What is the process and the method that went into place to make sure that every single mark on that ruler was perfectly spaced, so that when I measure something that says 2 inches, no, it's 2 inches. Nobody fucking thinks about that. You put the ruler down, it says a 2, and you say it's 2 inches, right?
It's not 1.9816, yeah.
Right. Or even, yes. So you don't have to understand the process by which the ruler was constructed to appreciate that a ruler works.
Well, no, I mean, I'm just going to say, I mean, and I will admit, it took me a little bit, and obviously we have a personal relationship, so you explain it to me more to grasp all the full aspects of what you do and all that fun stuff. But the numbers themselves are pretty simplistic, honestly, because you just look at the end result, and you look at the performance track record over the last 15 years. And, you know, one of the things I harp on all the time on some of the discussions we've had is how you did during the last crash. And I know you earned, I think it was 2000, I can't remember if it was 2008 or 2009, but you earned 41% positive return. When you earned that 41%, how many people did you have that had invested calling you to complain that they didn't understand how you earned them the 41% return?
That's exactly right. That's exactly right. No,
I'd imagine it's zero.
that's right.
But I'll tell you this, if somebody invested in the S&P 500 or they invested in one of the Charles Schwab mutual funds and they lost 20%, even if it had been explained to them perfectly, they're still pissed off they lost 20%. So,
and the entire financial advisory market is teed up for that again. They've gone through it in the past few months. They've gotten a bit of a respite with a bit of a dead cat bounce. But the smart money is expecting a very deep negative turn 2023. Those calls are miserable, but they're inevitable if all you're going to do is index, and whether you're indexing or not, you're indexing if you're running a 60-40 portfolio, right? You're all going to move in tandem. So you can put an end to those calls. You can end this inevitability or escape this inevitability of knowing that you're going to have that tough conversation with your client, potentially lose clients because the market did poorly. It's just a matter of, again, taking a merit-based approach.
well, how about pride of ownership too, or pride of, it's not really ownership, but pride in what you do, right? Because and I'm, again, so you correct me if I'm wrong here, because I'm kind of speaking from the outside looking in, but if I'm a financial advisor and I always succeeded when everybody else succeeded, and I always failed when everybody else failed, I'd have no pride of ownership in what I'm doing because I'm not doing anything myself. I'm just following the trends of everyone else. That to me wouldn't be fulfilling, to be honest with you. I mean, I would feel better about it, this honestly, again, back to real estate for me personally, I do feel a lot of pride and gratitude that 2008 to 2011 was the best percentage returns I ever had as an investor. And I have empathy and sympathy for people that were in the stock market or in traditional investment classes that were, losing their retirement funds or watching those slowly or rapidly evaporate. But for me, going against the grain and having success, that's really one of the big successes of my life. So I would imagine if you're a financial advisor, there would be a lot more gratitude if you had something that was your course of action that you could own, whether win or lose, success or failure, that wasn't just the same as everybody else. Am I crazy?
It's more than just pride of ownership. It's expressed in the economics. And what I mean by that is every retail advisor is experiencing what's called fee compression. And what that means is financial fee-based advisors, RIAs, get paid generally a management fee, 1% of the total assets under management that they've got. And because everybody's doing the same thing, they're all a commodity. And the only way they can differentiate from each other is by reducing their fees, the fee compression, right? So they just squeeze it, making less and less and less and less and less to where they can hardly even run their business. And now the way firms are differentiating themselves is they've just given up on investment advice and we'll give you tax advice too, right? We'll provide you tax advantage solutions. We'll be a multifamily office, right, that will provide ancillary services because we're not good at our core business, which is investment advice.
That's depressing, right? That's honestly depressing.
Yeah, it's bad. But the good news is that doesn't have to be the way a retail practice is run. And not only can you, when you employ an institutional approach of allocating to the best stuff out there, there may be some opportunities in the equities markets. There may be some publicly traded assets that are worth including. But when you look at the investment world with a holistic perspective and consider everything out there and construct a portfolio based upon what is best, now not only can you have pride of ownership and you run a differentiated business that you can market in a differentiated way, but now you can charge fees that are justified by a substantially better service and product offering. So for example, if you're looking at the alternative space, most of the worthwhile private funds, like institutional grade private funds, have very high minimums that are not accessible to retail investors. Fine. What a retail advisor can do is construct a fund of funds that is an entire alternatives portfolio. So you can have 5, 6, 7, 3, 10, whatever, private funds in this one fund of funds that the retail advisor creates. The retail advisor can charge a 2% management fee on that, plus a 20% performance on fee on that. If he's following the numbers, that should probably comprise 60, 70% plus of his portfolio. So now he's making not 1% a year on AUM, he's making up to 4% a year on the vast majority of his portfolio. To put that in perspective, if an RIA was to sell today, and there are like 50 buyers for every one RIA for sale, right? Even under those conditions, an RIA can only expect to sell for about 3x their current revenue. So for example, if I'm an RIA with $100 million under management, my revenue is probably about 1%, which is $1 million. So if I were to sell my RIA, I'd sell it for $3 million. 3x your annual revenue, your annual gross revenue is the value of your firm. I'm telling you, you can make that every year in perpetuity and never leave, right? Without increasing your client base at all. And have your client base thank you for the opportunity because their performance net of your fees is still substantially better than what you were offering them otherwise. Like there is no rational objection to this approach. You're moving from, you're moving from the security of, I'm doing what all the other retail advisors are doing and it feels safe, so I'm okay here. What we're saying is, yeah, I get that. I understand the deep-seated need to act in accordance with the expectation of your peers. I'm just saying move to a better peer group. Make the institutions your peers, right? Yeah. Where the real money is traded, right?
Well, let me ask you about this, Ben, because I really don't know the answer to this. But, I mean, as you know, and we've talked about it a lot, that was what attracted me to you as a retail investor and as someone that represents, all the members of my network that I do, was that I felt like from day one that you really made the opportunities for different investments and strategies that the institutions, the large players on Wall Street, the ultra wealthy elites, like I always say, are doing. You made these strategies that have been done for decades available to the general public. Is that, I guess you just kind of said it, but is that the same process that you're making available for RIAs, or how is it different?
Well, that's a good question. It's indirect. So you're right. We're not retail facing. The structured products and the funds that we engineer have at least $1 million minimum. So our allocators are other fund of funds, small pension funds, endowments, small endowments. We generally don't operate in the big institutional space because the bureaucracy that governs how they allocate is they've got the sophistication on staff, but the politics that govern how they run and operate make it more difficult for them to make merit-based decisions. The structured products and the private funds that we engineer have 7-figure minimums. That's not accessible to retail. Again, our allocators are fund of funds, small institutions, pension funds, endowments. But they can be made available to retail via financial advisors, exactly in the way that I described, by creating a fund of funds that allows them to better monetize their firm, provide objectively better product and service offerings, differentiate themselves, communicate that in their marketing, convert their marketing into a Pepsi challenge instead of a bullshit contest. And we go so far as to say, like, we're not even here to pitch our products. We're just here. We just want retail advisors to take a merit-based perspective and construct portfolios with the best available stuff. If that's our stuff, great. We'll win 9 out of 10 times. If it's not, that's great too.
Well, hold on, Ben. So talk to me about that, because you mentioned the Pepsi challenge, and that's a term that I've heard you use quite a bit when we talked about RIAs. And again, I'm a simple guy. I don't know a lot of the higher tiered financial terms that are used, but talk to me about what you mean when you say the Pepsi challenge as it relates to a financial advisor or an RIA, and what that looks like. How do
Sure.
you actually go into that? So I'm an RIA. I come to you and I say, okay, this is what I've been doing. I'm fairly happy with it. And you tell me you can do better. What does that look like?
So let's start with the typical perspective of the retail client that comes to an advisor. So when they come in, they're all saying about the same thing, which is, I want the highest returns I can get with the least amount of risk, right? It's the advisor who forces arbitrary complexity into the conversation. Oh, you need to be diversified across this and that. We definitely need to be in a 60-40 portfolio with no more than 10% in alternatives. And the retail investor's thinking, I didn't ask for any of this shit. Like, just give me the highest returns I can get with the least amount of risk. And then the advisor will say something like, well, you can't have return without risk, so the more return you seek, the greater the corresponding risk has got to be. Again, the retail investor, the potential client, didn't ask for any of this. And what I'm describing in terms of the risk-adjusted performance measures gives the retail client exactly what they're asking for and the language that they're asking for it. Here's your maximum drawdown. Here's the most you could lose, right? Here's your expected return, which is the geometric mean, the average of historical performance, right? Then there's something called the omega ratio. It's just the sum of the gains divided by the sum of the losses. So it's just a number. The higher the omega ratio, the better. And then finally, I'd throw in Modigliani, which is just a percentage. If the Modigliani measure is a higher percentage than what other advisors or assets or portfolios are demonstrating as an expected return number, then it's good. But in short, the point is that you can give the investor what they're asking for in the terms they're asking for it. So instead of talking about, instead of having to wine and dine and do lunch and learns and play golf and show off how pretty your office is and show how good looking your secretary is and look at all my leather bound books and my desk is made of mahogany, right? Instead of all of these things, right, you say, here is the accurately measured quality of my investment portfolio. I will measure the quality of any competitive portfolio or competitive asset or anything you are considering investing in or maybe currently be invested in. I'll measure it for you for free, right? When you show someone that there is a way that you can measure the quality of an investment, what they have, what they're considering, that potential client's going to ask you 10 other times, okay, well, how does yours stack up? What's the measure of your fund, of your portfolio?
And again, it's just common sense, right?
If yours is better, you'll get their money without ever even have to ask for it.
No, I'm nodding my head over here because, and it's funny because, even we were talking about today's podcast, I'm on the road here and all that, and it's not a fancy backdrop. We were talking about this earlier today in a different setting. But I said, if the content is accurate and it's quality, then it doesn't matter. I could be wearing a suit, and that would be a little bit better, I guess, but it doesn't matter. People don't care about that. People care about the end result. How does this better my quality of life? That's what I care about. That's what people I know that invest care about. And I can tell you, I could go into somebody's office, and I have. I've had people email me constantly. I get on LinkedIn, and I'm top 10 most connected people on LinkedIn, believe it or not. And I get constant spam emails from these big firms and all this wanting to talk about investment. I could go in. If they give me the same pitch that 6 other guys or gals gave me, that pitch means nothing to me. I could care less if they're driving an S500 Mercedes and they've got like you said, a mahogany desk. If someone shows me factual data that I can comprehend as an investor, I can say, oh, okay, this is my projected return and this is why it's better than anything else I could look at, I'm sold.
It's even better. You're not projecting. You're looking at actual historicals. And you're saying, okay, how did this investment or portfolio compare to this investment or portfolio across the 2008 financial crisis and every year since? So epistemology 101 tells you that if an investment did well in the worst economic conditions we've ever experienced and maintained that performance during normal times since, then there's a reasonable expectation that's a better investment. That this is how we know by past experience. And that's all that's being done. And so in parallel, I'll draw this in contrast. What is a con artist? What's a con artist do? A con artist is skilled at distracting his target from the point of focus, right? So the con artist will distract his victim by making him look at something that is irrelevant to the con being partaken in. That's what financial advisors do, right? Look at these heuristics. Look at these irrelevant considerations that people have assumed tie to a good investment manager. How about this? Just look at the investment.
Yeah, which is what it's supposed to be about, right?
Yeah, look at the investment, measure the investment. And again, when all investments should have administration and audits so that there's no opportunity for the numbers to be manipulated. But insofar as you know and you have these third-party checks and balances, which is where the financial services industry does a good job on the compliance and regulatory front, you're expected to have the audits, you're expected to have the third-party administration, especially when we're talking about specifically private funds. But when all that stuff's in place, when all of the operational check boxes have been checked, right? Now it's just a matter of the quality of the strategy that can be accurately and objectively measured. And that is all that matters. Doesn't matter if you like a pinstripe suit or a solid suit. Doesn't matter if you like IKEA furniture. Doesn't matter. Doesn't matter.
Well, at the end of the day, that's the reason why we invest, right? I mean, if we didn't care about the ultimate end result and how much money we make, then again, we just do it on our own, or we would just put it in the S&P, or we buy, treasury bonds or whatever it may be, or we'd buy gold. The reason why we go to a professional, an expert in that field, is to do better than we could do on our own, and to have comfort that they're going to give us opportunities that we wouldn't have on our own. And I just don't believe that's the case. I might be wrong, but my belief on it personally is that's not the case in the traditional world of financial advisory. I just don't think that's how it goes. And so that's why I was completely opposed to even the consideration of ever investing my money with someone else until I started looking at some of the things that you've done. But Ben, you did touch on one thing when you were talking there that I wanted to kind of triple down on, I guess, because I mentioned it earlier as well. But you talked about how you performed in 2008. What we're seeing right now, I talked about, in my opinion, how similar right now feels to me to 2007 going into 2008, and what that looked like from an investment perspective. Can you talk to me about the Adagio infrastructure as an investment bank and what you've been able to build there? You don't invest in any strategy or any opportunity, correct me if I'm wrong, that didn't have great numbers both during the last crash and during the recovery. Am I correct in saying that?
Yeah, that's correct. So you're right. We're not an asset manager in the sense that we have a strategy and we're wrapped in a fund and selling it. Our role in the market is to go find the asset managers who can generate and have demonstrated the ability to generate better risk-adjusted performance, substantially better risk-adjusted performance than what's otherwise available through traditional markets. And we're completely asset class agnostic. So we've got everything on our platform from algorithmic equities traders, real estate, private equity, synthetic risk transfer, private credit, you name it, we've got it. And what we do is we take the best strategies and we wrap them in strategically engineered funds and structured products that bridge the gap between the capital terms needed by the strategy of the asset manager and the appetite for performance in the capital markets. So for the past decade, we've spent most of our efforts converting equity into fixed income because there was no real yield in the fixed income space. So we engineered products that generated real yield at treasury level risk. Now, since January, people realize that, hey, inflation's a thing and the S&P has done poorly. So there's been a substantial uptick in demand for equity, so we're issuing more equity now. But what we do is we find, again, asset managers who can generate substantially better performance than what's otherwise available. They go through a 3 to 6 month process of verifying, underwriting, measuring that performance. The second phase is the financial engineering, where we create and engineer the fund that wraps that strategy, paper it, create all the legal docs, and then distribute that through our infrastructure.
Well, I don't want to cut you off, but so you kind of brought up a good point that we really haven't talked much about yet. But so if I heard you right there, and again, I'm going to kind of put it in layman's terms. So you basically help evaluate the most prosperous and consistent investments. You then engineer a compliant structure to be able to participate in those investments. And that's how I originally met you. I was doing marketing for an investment fund, and they brought you in as a compliance expert. And so that was how I originally thought of you before I realized all the other things you're doing. But then the piece that we really haven't talked about is you actually then help raise the capital as well, or talk to me a little bit about on the marketing side, or if I'll put myself in the RIA role. If I'm looking to scale up my existing operation, how can you help me scale?
As I mentioned, we have over 100,000 high net worth individuals in our ecosystem. I know, Stefan, you have over 2 million investors in yours. We're also, got a few friends. We're also partnered with Intersection Capital on the distribution front. So we have an extraordinary outreach and infrastructure in terms of the ability to access retail investors. And so through their exposure to our materials, as they are introduced into our world, our ecosystem, they are taught and conditioned to look for and expect better investments as accurately measured. And so we're not positioned to handle the retail piece directly. So we need to refer that out. And for the past few months, we've undertaken the initiative to select a handful of RIAs who are committed to growth with integrity, that can assume this merit-based approach. We'll pilot, say, 15,000 of these high net worth individuals to them, work with them to work with the RIA to bring those clients on board, and then we'll help the RIA in the back end to construct the portfolios that deliver on what these clients are expecting and looking for in terms of their investment portfolios.
Well, and Ben, I mean, just for my 2 cents and my involvement, and I know, I've kind of committed to make my network available for that process. And I'll just speak on the reasons why I'm doing it and our mission statement with the Real Estate Networking Group. And you can correct me or if I'm wrong, or talk to me about how similar it is for you. But I think it's pretty similar. I mean, for me, I learned so much as an investor from the last market crash, and it really was heartbreaking to me that I had so many family members, friends, people that I knew well, people I didn't know well, that would come to me and talk about how they were, I had family members that told me, their retirement account that they'd been building up for 40 years was now down 70%, one in particular. And a lot of people in a similar boat. Meanwhile, I was out there in the real estate sector making a killing. And I'm thankful for my success, but it killed me that other people didn't grasp this, and that they weren't, in many cases, honestly, they weren't willing to think outside of the box to be able to grasp it. And so that's what led me in general to want to do the webinars, to want to have these conversations and engage with people, to let them know, hey, there is a different way. There's a more fundamental foundational process you can go through that's based on merit, that's based on numbers, that you can evaluate your investment and you can do better. And that's why I'm thankful to be able to invite anyone in my network to engage in your process, and anybody on the RIA side, any financial advisor that's been vetted, that understands it, and that is willing to engage in that practice, that we can have trust in them. I'm thankful to I want my people, I want myself, I want to have access to that opportunity because it's going to better all of us. So how similar is the mission statement? And I'll give a little more detail on that too. How much of your reason for making this available is just supply and demand, where we've got all these hundreds of thousands of people that want access to these opportunities and we don't have the means to fill it? And how much of it is that you genuinely want financial advisors to understand there's a better way to do things?
There's a component of all of that involved, right? So from a sheer numbers perspective, if you look at our list, we've got 20, 30,000 institutional contacts or 20, 30,000 institutions in our ecosystem. We've got over 100,000 accredited investors. You've got 2 million investors, right? And so it doesn't make any sense to just let that sit, right? So it's a win-win for everybody involved. Again, we're not positioned to deal with individual retail investors, but financial advisors are. That's precisely why they exist. At the same time, financial advisors suffer all the challenges that we discussed: fee compression, inability to grow, challenges in the marketing front because of a lack of, again, differentiation, inability to further monetize the base beyond pursuing, other services that are effectively non-core. And so we can help the entire segment by bringing merit to that space. And there is no rational objection to what we are offering. So those who have the ethical standards, again, the integrity to do the right thing, the intellectual capacity to recognize what the right thing is, there's just also like sort of a fundamental need for and desire to work with kindred spirits, right? So it's a win. It's a win from every perspective. It's a win from every perspective. It's a win from just a personal perspective. It's a win from a financial perspective for the RIA. It's a win from a financial perspective for us. It's a win for the industry at large. Again, there's no reason not to run an initiative like this, and I'm kind of disappointed in myself that it took us this long to kick it off.
Well, no, and honestly, Ben, there's probably a large percentage, and I don't even know if you know this about me, but when I was 19 years old, or I guess I was 20, I can't remember, but I applied to work at Waddell and Reed. And I was going to get my series, whatever the heck it is, series, I can't remember the first one. Series 6, is that the first one?
6 or 7. 7 is a general securities license.
Yeah, I can't remember. One of the two. And I went through. And my point being with that is I'm about as against the grain as you can get, right? And I obviously didn't go that route, but I wanted to. And had things fallen a little bit differently, I might have. And then I would have been in that boat as a financial advisor that wanted to do things in a different way, but maybe people just don't have access to it, and I can't imagine any reason, unless you are either, about to be neighbors with Bernie Madoff, or unless you're, getting some kind of kickback. Why would you not want your fundamentals to be evaluated on merit?
Yeah. Well, I know why, because most retail advisors came up under a big firm. And that big firm indoctrinated them to sell the big firm's products. And now it's just baked into their identity, right? Yeah. Their identity is to sell things the way they were taught when they cut their teeth. And disappointingly, a lot of people just don't have the capacity to recognize that and to separate themselves from it. But some people do. And those are the ones we're speaking to.
That's what I was just going to target too. So yeah, I mean, if there's people that are listening to this that are financial advisors, and you're kind of feeling like, I'm happy with how it's going, but there's other opportunities, and anytime there's an opportunity that could make more money for my clients and for them too, right? Because with this infrastructure, like you touched on a little bit earlier, not only is it a better opportunity to have a more stable performance track record for the investor, but the financial advisor actually makes more money as well. Am I correct in that, right? Because of the structure itself?
Yeah, it's business the way business was meant to be. And what I mean by that is you make more money because you're offering an objectively better product and service that is rare. And people talk about first world economies, the United States, it being hard to start a new business or grow because it's a saturated economy. Everything's already been done. There is no bigger hole in any economy or any market than there is in the investment market. The biggest hole ever. And the hole is, how do we evaluate the quality of an investment?
Well, and so many people don't do it that way, right? Like even, I mean, I'm just speaking on the retail side of things, but so many people invest because, oh, well, I go to, my kids go to school with this person, or, I saw this on the news and it makes sense. It's very rare that people actually evaluate investments based on the performance, which is kind of insane if you think about it.
No, nobody in the retail space does. This is the domain of the more sophisticated institutions. And that's the whole, right? There's nothing that precludes you from bringing the institutional approach to the retail market and then get paid handsomely for doing so and dominating your market, because now, yeah, you're getting paid more, but the net to your clients is substantially better than anything that otherwise have access to.
So Ben, and again, I'm speaking from the investor side of things, but if I am a financial advisor and I'm listening to the content that I'm hearing today and I'm intrigued by it, is there an opportunity for me to engage with you directly or someone on your team and evaluate what I'm doing and see if there is a fit, either in a partnership format, an educational format, or whatever it may be, to at the very least measure my strategy against yours, or combine the two? How would I go about that?
For fee-based RIAs who are committed to growth with integrity, I've opened up my calendar to interview them, to run those who show promise through this pilot program to test their ability with about 15,000 high net worth individuals. And then from that group, select, again, 3 to 5 to work with in perpetuity and scale them through our distribution infrastructure.
Well, and Ben, I'll just say this, and I'll close from my side, with this thought here. I do think, as I've said a lot to my network recently on all the webinars, podcasts I've been a part of, I think that right now that type of oversight is more critical than it maybe ever has been, certainly since it has been since 2008. And so, again, I'm thankful to contribute access to my network and what you're doing. I think it's a powerful thing. I think it's a valuable thing. And I think that the more knowledge that everyone has, whether you're a financial advisor or whether you're an investor, on how to properly evaluate investment strategies from a standpoint of fundamentals and merit, I think it's only going to help as we move forward. So I thank you for having me on and let me be a part of this. And I look forward to sharing, your strategy continued with my network and whatever other individuals end up ultimately being a part of it.
Great to connect with you as always.